Auditing Standard SA 240 Part 1. In this video, we will be discussing the auditing standards related to fraud and risk assessment procedures. Let's start with SA 240. This standard defines fraud as a deliberate action resulting in misstatements in financial statements. The standard distinguishes between two types of intentional misstatements relevant to the auditor: misstatements resulting from fraudulent financial reporting and misstatements resulting from misappropriation of assets. The standard describes the characteristics of fraud. SA 240 includes incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. The auditor is concerned with fraud that causes a material misstatement in the financial statements, and although the auditor may suspect or identify the occurrence of fraud, they do not make legal determinations of whether fraud has actually occurred. Requirements: the SA 240 also provides guidance to auditors on how to identify and assess the risks of material misstatement due to fraud, and how to respond to those risks in an audit of financial statements. Moving on to requirements, SA 2003 outlines the requirements for professional skepticism in auditing. Professional skepticism is defined as maintaining a questioning mindset and recognizing the possibility that a material misstatement due to fraud could exist, even if the auditor has had positive experiences with the honesty and integrity of the entity's management and those charged with governance. The auditor must consider the reliability of the information used as audit evidence and the controls over its preparation and maintenance, particularly when considering the risks of material misstatement due to fraud. SA 315 requires a discussion among the engagement team members, with a particular emphasis on how and where the entity's financial statements may be susceptible to material misstatement due to fraud, even if team members believe that management and those charged with governance are honest and have integrity. The discussion also considers how audit procedures will be selected and what to do if allegations of fraud are discovered. Finally, SA 3155 requires auditors to perform risk assessment procedures to gain an understanding of the entity, its environment, and its internal controls. Risk assessment procedures and related activities. The auditor is required to inquire with management about their assessment of the risks of material misstatement due to fraud, and to make inquiries of management and others within the entity to determine whether they have knowledge of any actual, suspected, or alleged fraud affecting the entity. The auditor is also required to obtain an understanding of how those charged with governance exercise oversight of management's processes for identifying and responding to the risks of fraud in the entity, and the internal control that management has established to mitigate these risks. In conclusion, auditors must be vigilant when it comes to fraud and risk assessment procedures, and must maintain professional skepticism to ensure the accuracy of financial statements. Thanks for watching.